Good morning, everyone. This Sunday morning, December month, we all are sitting over here with a cup of tea for the valuation session. This is the 35th session, and friends, it is our endeavor to serve all of you the best with Sunday morning, increase the value of chartered accountants' knowledge. And today we have come out with the session on valuation of the restaurants and food business. So this is the very important topic because food and the restaurants are the basic necessities, and uh, how to the value of it is increasing day by day in this era of sustainability requirements. And for that, we have invited Mr. Sujay Pai, who is from Mumbai, and will address all of you with the session on this, share his valuable knowledge on this special topic. And we have Shruti Gupta with us, who will coordinate the session, and our chairman in absentia, giving the best regards to all of you. So, friends, with this welcome note, let us have this session, a great value-added session on this Sunday morning. With this, I request Shruti to take this session further.
Thank you so much, ma'am. Thank you so much for inaugurating the session and sharing the words of wisdom with us. So, with ma'am's kind word and her wisdom, we are here to start with the 35th session, which is on valuation of restaurant and food business. So, with this, without any delay, I would like to welcome our speaker, CA Sujay Paiji. Thank you, sir, so much for gracing us with your presence. Sir is an accomplished professional. He is a chartered accountant, a cost accountant, and SEMA UK qualified. Sir is a director for the valuation practice in BDO since 2017. Prior to joining BDO, he was associated with Hari Bhakti Group for 7 years. Sir, you have successfully carried out assignments in the areas like valuation of business, equity, and intangibles for mergers and acquisition, arbitration across spectrum of companies in telecom, power, infrastructure, pharma, as well as portfolio valuation of AIF and other funds. You have also carried out valuations required under IFRS, Ind AS, purchase price allocation, impairment testing, transitional fair value accounting. Sir has executed various marquee transactions involving various regulatory agencies like Securities Exchange Board of India, Reserve Bank of India, and other leading institutions. Sir, with such vast experience and knowledge, we are sure that in next 2 hours you will share with us immense insights, and we all are here eager to learn from you. Thank you so much, sir. Once again, I welcome you, and over to you, sir.
Thank you, Shruti. And good morning, everyone. So the topic that I'm going to present today is valuation of restaurant and food business. I'll just share my screen. Is my screen visible?
Yes, sir.
Yeah. So I think we'll start with the session now. So let's first start with food. Now, food is a basic necessity of human beings. Now, if I want to plot it on the Maslow's hierarchy table, the hierarchy pyramid, food will be at the bottom of the pyramid. It's a basic necessity for everyone. And probably that is precisely why it's a very big business anywhere in the world. And of course, given the population of India, it's a big business in India as well as a lucrative business. Now, basically, the topics that I am going to carry out on restaurant and food business, it basically comes under two criteria, two classifications. One is HoReCa, which is basically hotels, restaurants, and catering businesses, and other is the food processing or processed foods and allied food businesses. To speak about HoReCa, Horeca can again further be, now this is basically for the industry analysis part. The Horeca businesses can be classified into two segments. One is the organized and one other is the unorganized segment. Within the organized segment, we have single outlet businesses and multi outlet or chain businesses. Single outlet businesses are basically all those local hotels, restaurants, cafeterias, and multi outlet chains are basically big chains like JW Marriott's or Taj, Mahindra Holidays, and those kind of uh, chains which have pan India presence. Now, these are the organized business or something are businesses which are registered with the government. There are unorganized businesses in the Horeca segments, like you have your dhabas, you have the street vendors, food stalls. Recently, you can see many of the food trucks that are there in place. And these are basically unregistered ventures. These are scattered across India, and typically these are hyperlocal or restricted to specific region. Within the food processing, it covers a gamut of sub-segments. You have the grains uh, business, you have the pulses, you have all oil seeds, spices, you have dairy and other value-added dairy products, you have beverages, so on and so forth. Now, recent trends that we can see in the food processing segment are basically you have all these nutraceuticals coming up. There are these superfoods coming up like jackfruit 365. You have all those millets programs that are getting announced, and millets like your jowar, bajra, and those kind of healthy
Sir,
products. Yeah.
sir, I'm so sorry to bother you in between. Your video is stuck for our participants. So can you just stop your video? Maybe because of the Zoom upgrade we discussed, it's not. Yes, sir, it's perfect now. Please carry on. I'm so sorry to
No.
stop you.
Yeah. So we have these millet programs that are launched with the support of government also, and there are many of the companies which are kind of manufacturing and marketing the millet-based products. There are ready-to-eat and ready-to-cook products that have also been sold in the markets. Plus, with the advent of technology, we have technology platforms like Zomato, Swiggy, which are there in this kind of businesses, which are aiding the small and the local shops to kind of have a larger delivery services to their customers. And then there are cloud kitchens also, which kind of take orders from multiple hotels and restaurants and can deliver to the customers without having their own kitchen. Within the Horeca segment, if we see, it contributes to about $78 billion annually to Indian economy. That's more than 7% of GDP. It supports more than 50 million jobs. It accounts for almost 10% of the government tax revenues. Now, this kind of gives a sense of what is the size of the Horeca market, and the size of the contribution that it makes to the Indian economy. By 2030, it is supposed to reach a target of US dollar 450 billion vis-a-vis the 78 billion that we are talking about today. Apart from the Horeca, in the food processing, India is any which way is the major producer of food in the world. Food and grocery retail market itself is valued at USD 11.3 trillion, and that was in 2021. Today we would be much ahead of that. The organized sector employs about 2 million people in the food processing segment, and the unorganized sector about more than double of that at 5.1 million. Food processing sector is expected to reach about $535 billion by 2025-26. Now, coming to valuation process for either a Horeca business or a food processing business, the first step to start a valuation is doing the due diligence of the business. Now, primarily the due diligence is through the initial review of the uh, business model and the data provided by the company, the document shared by the client, that can also be married with the information that is available in the public domain for the target company as well as the comparable companies, and the same can be analyzed on the basis of the information provided and the analytical tools that we can use to analyze the uh, financial financials as well as the financial projection provided to us. The next is the premise of the valuation. Depending on the purpose of the valuation, the premise of the valuation can be selected. For most part, it will be a going concern value. However, if there are situations like a case of liquidation or a distress sale, then a valuation premise can be as is where is basis, or an orderly liquidation or distress value. In terms of selection of valuation methodology, we'll talk about it in detail in the further slides, but primarily, as in any valuation, there are three main approaches: the cost approach, the income approach, and the market approach. In terms of market research and analysis, this is again for the use of methodology of market approach, where we can identify the companies that are engaged in this similar business. We can analyze the information of those comparable companies. We can work out the multiples that are applicable to that particular company and then use those for the purpose of our valuation. Once all this is done, the step is to undertake the valuation by having done an analysis on the information that is made available to the company, the discussions that have been had with the management, and understanding on the strategy of the management going forward, how that is being built in the projections, taking a comfort on the projections. We can then move on to doing the actual valuations by using the assumptions provided by the management as well as the valuation assumptions that on the basis of our analysis we can come to. And thereafter, the conclusion on the valuation by giving a valuation report that suitably captures the entire process of how we have done the valuation and the outcome of that by way of the final value that we have arrived. Okay, now in terms of valuation approaches, we basically have three approaches primarily that can be used for the valuation. The cost approach. Now, cost approach basically consider the assets and liabilities, including the intangible assets if they have been recorded in the books, and the contingent liabilities also can be given effect to. However, the cost approach do not capture the value of intangibles for which there are no historical cost associated or they have not been accounted in the books. And it does not capture the future earning capacity of the company for which the valuations we are conducting. Primarily, there are two approaches that can be used under the two methods that can be used under the cost approach. One is the summation method, which is primarily the book value method, wherein you value all the assets and liabilities that are there in the financial statement as on the valuation date, and then whatever is the book value at which they are carried on. If in case there are investments, we'll value those investments separately by a similar methodology and then accordingly do a summation method to arrive at the value under cost approach. Under the breakup value, we can have identify individual assets which are drivers of this business. Let's say for a restaurant business or a hotel business, it could be the property. So we can value the land and the property by using the tangible valuation methods for valuing up land, building, and any associated equipments, and all are there. We can value them, have a fair value of them. And for the other assets, like your current assets, current liabilities, they can be valued on the basis of realizability of those particular assets, and accordingly a breakup value can be arrived at under the cost approach. Under the income approach, we generally have the discounted cash flow method, which takes into account the future prospects of the company, the strategies of the company in order to grow beyond what it has historically grown, and the expected performance of the company that is captured by way of the future projections that has been provided by the client and that which can be analyzed by us. In terms of market approach, here the indicative value comes generally from identifying the comparable companies or comparable transactions that are similar to our business, either in the restaurant business or the food processing business. And the methodologies primarily here are the comparable companies multiple method and comparable transaction multiple method. In terms of valuation of the restaurants, will go through the process primarily that can be considered. One is to identify the operational value drivers. The operational value drivers for a restaurant business basically can be the location of the restaurant, typically where the location of the restaurant is. If it is in a area where there is a strong football, let's say inside a mall or on a busy street, that can give us a sense of how the projections should flow through. The concept, theme, or the ambience of the restaurant, typically the menu of the restaurant in terms of uh, different types of cuisines that can be covered and which can be provided by the particular restaurant or hotels. Then the staff quality, basically the chef and the waiters, and the property maintenance. In case of an hotels or resort, the way in which the property has been maintained, that are primarily the operational value drivers. In terms of cost drivers, it can be how the operating costs are controlled. In terms of occupancy rates, these are basically over the full year period. There would be seasons and off seasons, peak and uh, seasons, which typically gives us what an occupancy rate of an hotels basically is, depending upon the location, depending upon in which uh, area it operates and all, the occupation rates can go as low as 30-40% to as high as 60-70% also. Then the growth and maintenance capex. Now, typically, if it's a hotel resorts, so these would have some amount of maintenance capex in order to maintain the properties, even for restaurants as well. And then, if there are any expansion plans and all being let's say some amount of surplus land or something is available with the company and they plan to set up uh, an expansion project to the current hotel, then in those case even the growth capex can come into play and we can always analyze that as well. Further, in terms of models, either it's a company owned company operated model or company for a chain of restaurant can go with a franchisee model also. So even that would affect our analysis of costs to know whether it's company operated or it's a franchisee based model. In terms of profitability and valuation drivers, we have the EBITDA and PAT margins that can be analyzed over last 3-4 years and then what has been projected. In case of projections, we can always, if they are not in the range of margins that have been achieved in the past, we can always check with them on the strategy that they are adopting in which could result in a higher EBITDA or PAT margins. The ROCE can be checked to check the capital efficiency of the company. The tax rate, typically here the tax rate would be the minimum marginal rate of tax. The cost of debt and cost of equity, this would help us to build the WACC for the valuation, and the risk factor that can be analyzed in order to assign a specific risk premium for the target company that we are valuing. Let's start with a discounted cash flow method example for the valuation. So here, this company ABC, now this is a Kolkata based company. It operates a 281 rooms, 5-star deluxe hotel. And usually this may not be there in other cases, but in this particular case, it was having a 51 ultra luxurious service rooms or residence in Kolkata, which was up for sale as well. So the details of the projects are in the table below. The presidential suite. So basically, all these details can be taken for breakup, can be taken for a detailed analysis in order to analyze the operating parameters of the company, as well as to assign a specific risk, to analyze the projections and to assign a specific risk. Presidential suites, executive suites, deluxe executive and deluxe rooms. So that breakup gives a total of 281. In terms of service residence, again we had a breakup of different types like Ruby, Topaz, Zade, and number of apartments that were there in the individual specific type of rooms. So in total it was 51. Now this was a three basements plus ground plus 28 floors high rise building, 51 luxurious apartments having various amenities also attached to it. In terms of the discounted cash flow method, the first thing that we analyze is the costs and the profitability. So in this particular case, primarily you have the revenues that comes from the operation of the hotel. And also, since this particular case had real estate in terms of the service rooms and service residences, there's a specific component of revenue coming from that business as well. Otherwise, usually in a restaurant business or in a hotel business, you'll have income from operations of hotels only, which could again, the breakups could be room rentals, there could be breakups as to beverages and those the other facilities that the hotel generally provides. In terms of COGS, it usually includes the food and beverages and other costs that are there. In this particular case, it was in the range of 15% of the revenue. The employee costs again is for having all those salaries, wages, gratuity, and other normal contribution to PF and other funds and staff welfare expenses. The other cost usually includes room costs, refurbishments, repairs, maintenance, sales and marketing, utilities, rent, taxes, all those things. Now, this is the projections. Here, basically the revenue from the hotels can be analyzed further by having a breakup of the rates that have been considered, the occupancies that have been considered over the full year. So the room rates of the hotel can be compared with the trends that are usually prevailing in the nearby vicinity of similar properties, or it can be compared with the trends of the room rates of the same company over last 3-4 years as well. The occupancies also can be estimated on the basis of past trends, and any increase or decrease in the occupancy rates can be discussed with the management in terms of the strategies that they are going to adopt to increase those occupancy levels. And the costs and margins can be analyzed with the past trends and any variations. So costs and margins, basically, again, the EBITDA margins and all can be seen with respect to what has been achieved in the past. Also, while we do a comparable companies analysis, we kind of understand what range of margins it should be at and if the projections are in a way aggressive or do not meet with our analysis on what the margin should be, that can be discussed with the management, and we can have an understanding on the strategy and then accordingly make the adjustments in our valuations. So major assumptions that can be considered for the DCF method is one, the cash flows. Now, typically, a cash flow can be projected for a number of 5 to 7 years. However, in a specific cases, it can be a longer period also. In case, let's say, a case where uh, the there is an agreement that the management has entered into in order to operate that particular property for, let's say, 10 years. So in which case we can have a higher period of projections as well. Consideration can be given to the working capital and the capital expenditure. In terms of working capital, we can analyze the inventory levels for the food and beverage inventories. For the receivables management, we can understand how the debtors are being managed. For the capex, we can always see what the maintenance capex is and what the growth capex is, and we can analyze them in terms of the capex strategies that the management has and accordingly factor it in our valuations. Appropriate income tax rate needs to be factored in. The project can be valued. Typically, I have used the FCFF method over here. So in case the debts are such that it is going to get repaid, and then there is on a long term level there is no expectancy of having debt, then our FCFE model can also be used. But generally, there is a target debt equity ratio that typically stays in this kind of businesses uh, because of the inherent nature of these businesses, and hence typically a FCFF method is used. Risk premium, again, on the discount for the purpose of discounting factor, can be considered on the basis of if the restaurant project is a new project, on the basis of construction status, approval status, all those factors we can consider a risk premium. In terms of operating hotels, on the basis of quality menu chefs, brand profile, let's say a local brand would typically carry a higher risk, but a known brand like JW Marriott, those kind of well-known brands would have typically carry a lower risk. The user ratings and reviews, now typically today with the advent of platforms like Zomato, Swiggy, and also in terms of the reviews that are given on the platforms like Google and all, we are able to understand a sense of the ratings that a user assigns to such kind of companies, such kind of hotels or such kind of restaurants, and those can be also considered in order to understand uh, the customer insights into this business, and the risks can be accordingly factored. There will be financial risks in case of heavy debt taking companies. In terms of the projections that have been given, the risk can be analyzed in terms of how the growth has been projected, and whether if it is aggressive in comparison to the growths that have been achieved in the past, we can always assign a higher risk factor to such projections on the basis of our analysis. The WACC is thereafter calculated, and the FCFF is then discounted at the WACC to arrive at the NPV. So these are basically the common terminologies that are there in the discounted cash flow. The FCFF typically is the cash flow that is available to all the capital providers. both the equity and the debt. The cost of equity is typically the return that is required by an investor for holding the equity of the project. Now, it is typically calculated by using the CAPM method, the capital asset pricing method, where we have the risk-free rate, which is generally either a ZCYC rate or a government bond yield rate that is used, and that the risk-free rate plus beta, which is the variability of returns of a specific company in response to the variability in the index. Now, this can be calculated for the comparable companies in case the target company that we are valuing itself is not listed. So beta of comparable companies to a index like a Nifty 50 can be used to compute the beta. The risk market returns is typically the market returns that is generated by an equity investor in India and can be gauged from the returns generated by the Nifty or the Sensex over a long-term period of say 25-30 years. Typically, a market risk market risk comes in the range of 13.5 to 14% if it is calculated. However, there is also a factor of dividend that gets paid off, which doesn't get captured in the long-term returns calculation. That would be in the range of 1 to 1.5%. So typically, a market risk comes in the range of about 15%, which is the capital growth plus dividend yield. So once RM is reduced, once RM minus RF is done, multiplied by beta plus risk-free rate, that gives us the cost of equity. The cost of debt again can be gathered from the information provided by the management in terms of the debt that they have already taken for the companies and for which covenants are already available, and for the debt which is projected, what is the estimated rate of debt, rate of interest that the management thinks of, and what is the general trend of interest rate that can be seen, and accordingly a cost of debt can be considered. The debt cost plus equity cost will give us a WACC. In terms of cost of equity, typically we can analyze factors on the basis of which we can assign a specific risk premium to the target company that we are valuing. One is the location of the hotel, restaurants. We can understand the location of the hotel, restaurant. So typically this location of the hotels, restaurants is again based on the footfalls that can be had for that particular region, for that particular state, or for that particular city. We can also analyze the competitors that are there around the vicinity. In case, let's say we are valuing a 5-star hotel and there are about 3-4 more 5-star hotels in the vicinity of the same, we can probably gauge the projections in terms of that competition intensity and accordingly adjust the risk in case the projections are given aggressively by the management. In terms of profile of the restaurant and brand, again, the restaurant or hotel can be a starter, can be by a starter promoter or an intermediate or an experienced promoter, or it could be a chain of hotels as well. All these can be analyzed in order to understand the risks that are there with the achievability of the projections, and for these particular factors we can assign specific risk percentages. In terms of user ratings and reviews, as I said, we have Zomato's, the Google reviews, we have We have travel portals like TripAdvisors, Expedia, Travel Triangle, in which users who have experienced these the specific hotels, they kind of put up their reviews and they are rating them. So even that can be gauged to understand what is the consumer preference towards the specific hotel property that we are valuing, and accordingly, for the achievability of the projections, we can assign specific risk premiums for these parameters as well. There could be financial risk in terms of the amount of debt that has been taken by certain hotels. We can gauge the interest coverage or the debt service coverage ratios that are there in the projections, and accordingly we can figure out what percentage of risk premium we can consider for financial risks. Then there could be cash flow risks based on uh, the growth that has been considered in the projections, as well as the EBITDA margins that has been considered in the projections. We can map them as against what the competitors are doing, what are the long-term demographic or the tourism trends. Now, typically for an hotel or restaurant industry, it is driven by tourism, largely either leisure-based tourism or business-based travel, and accordingly that factor can also be considered in order to understand the cash flow risks and specific strategies that the management may have in place for achieving those projections. And in case a valuer is still not uh, satisfied with the explanation given by the management on the basis of their analysis of the competitors or the regional demographics or the tourism trends, we can always assign a higher risk for those projections, and accordingly the discounting factor can then be arrived at. Now, in this particular case that we did, the cost of equity here was in the range of 15%. 3% risk premium here was added to the cost of equity to arrive at a cost of equity of about 18%. The cost of debt that was provided by the company was about 8%. We have applied a tax rate of 25% to the debt because of the tax shield available on payment of interest. Post the tax shield, the cost of debt will come to about 6%. The debt to equity has to be computed. Now, typically, a debt by debt to equity is computed on the basis of debt plus book value of equity. However, it can be computed by way of debt upon debt plus market value of equity also, in which case the book value of equity is replaced by the market value of the equity, and accordingly the same can be computed. With a 55% debt to equity ratio, the WACC was then arrived at 11.4%. Now, this is a case where we had typically a long-term projections available, and the same was used because of the presence of the real estate component also, which ran up till 2032 or so. So the inflows were accordingly plotted. The total outflows are then plotted. The free cash flow is arrived, which is basically the inflow minus outflow. In the outflow, you would have typically, so the inflows would basically be the cash EBITDA of the company. The outflows would typically have the incremental working capital items, capital expenditure, both the growth capex and the maintainable capex, and then the tax component is removed, and then we arrive at the FCFF. Now, for the terminal value, generally a range of 2 to 5% is something that can be considered. Now, basically, a terminal growth rate typically goes with how a how a company will grow over perpetuity period, and typically it cannot grow beyond what a country grows at. And a country like India, which may not be a fully developed country, but still it has a lot of steam left. Typically a developed country grows in the range of 1 to 2%. However, India still having a lot of growth left, a bit of a higher growth rate can be given. So generally we use a growth rate of 2%, between 2% to 5% for the terminal growth period. In this particular case, given the location and the brand and all, terminal growth rate of 5% was considered. In terms of so partial period factor. Now, typically a revenue will not flow throughout the year, will not flow only at the end of the years. Hence, in order to take that factor into account, that the revenue accrues over the year, we have basically considered the midpoint factor for the purpose of applying the discounting factor. And on the basis of the midpoint factor and applying the WACC of 11.4%, the present values were arrived at. The present value of explicit period is just the sum total of all the explicit period values. For the terminal values, again, the Gordon growth model is used, which is typically the cash flow of the last year divided by cost of equity minus growth. Since we have already built a long-term projections and they are more or less stable, we have used the Gordon growth model for the terminal period. In case it's a very new hotel or some kind of a startup business, and the explicit period does not capture the growth till the stability, one can also consider a two-stage model or an H model instead of a plain Gordon growth model, where till the stability a higher growth rate can be assumed, and thereafter the perpetuity growth rate can be assumed, and accordingly the terminal value can be calculated. So the summation of explicit period value and the terminal value will give us the enterprise value. From the enterprise value, we need to adjust the below the line items like the debt, the surplus cash, the investments, and any other surplus assets or liabilities are there. In certain cases, there could be contingent liabilities also. For instance, any income tax liability or some kind of GST notices issued, and all those factors, the contingent liabilities can accordingly be calculated, and a level of probability can be assigned on the basis of the discussion with the management as to what is the strength of defense that a company has against those contingent liabilities, either to have it in their favor or against them, or in case there are any lower court orders, the same can be considered, factored in, and accordingly the contingent liabilities also can be adjusted below the line to arrive at the equity value of the company. So from the discounted cash flow method, we now move to the comparable companies and comparable transactions multiple method. Now, typically, the approach for this comparable companies, comparable transaction method remains same. Either it's a horeca business or it's a food business, or it's any kind of business that needs to be valued. The only difference is the parameters that we use for multiples that I'll come to in the later slide. The first step here is to analyze the comparable companies. Now, in terms of, let's say we have to value a hotel, so we need to figure out the similar companies that are doing the hotel businesses, or if it is chain of restaurants, So we need to figure out the businesses are a chain that are listed and are a chain of restaurants. So let's say we have the Burger Kings and the McDonald's and those companies which are listed, and we can have them as the comparable companies for chain of restaurants or QSRs. For hotels, then we have IHCL and all, which is listed. In terms to identify a, a listed company that is most comparable to our target company, we can also look at the geographies at which our company is operating and at which the comparable companies is operating. So typically there are listed companies which are have a large presence in the west of India or in the north of India. And if our target company has a similar presence, we can only select those comparable companies which operate in a similar geography. So similarly, even we can have a look at the target customers and select companies which largely target those target customers. In case we are our target company is a significant a five-star deluxe hotel kind of a company, we can have comparable companies which operate such kind of hotels rather than taking uh, the the comparable companies which do not typically operate a five-star hotel. Similarly, once the comparable companies are identified, the next step is to identify the parameters of multiples that we are going to use. Now, typically, as like in other businesses, we could have the EBITDA multiple or a sales based multiple for the valuation. However, for the hotel, another multiple that can be used is basically a per key or a per room multiple also. So in this per key or per room multiple method, basically for the comparable companies that we have identified, we need to also map as to how many rooms or how many keys that part of in each of their hotel those particular comparable companies operate, and accordingly their enterprise value is then divided by the number of keys or the number of total rooms that are there, and we get a per key multiple, and that per key multiple can be applied to the number of rooms that we have. uh, and yeah, so the sales multiple, EBITDA multiple, or the key based multiple, room based multiple can be applied to our target company, and the fair value of our company under CCM, which is comparable companies multiple or a comparable transaction multiple, can be arrived. So similar process can be applied to comparable transactions also. There are databases like VCC Edge or Private Circles, which also captures typically the transactions and deals that happen in various sectors and industries. And accordingly, for the hotel or for the restaurant industries, we can always map from those databases. And as far as a full set of data for the comparison and for the calculation of multiple is available, we can use those multiples to calculate the CTM multiple and accordingly apply it to our target company and arrive at the valuation under the comparable transaction multiple method. Typically, this is again the uh, example for the CCM method that we had used for the same company ABC that we discussed for the discounted cash flow method. And herein we have used various comparable companies like Advait Housing, we have used Asian Hotels East Limited, Asian Hotels North Limited, we've used Gujarat Hotels Limited, HLT Limited. So all those companies we have used, and we have mapped the enterprise value of this particular company by taking the market capitalization. So now this market capitalization again can be considered on the basis of 3-month prices, 2-month prices, or on the basis of the SAST or the preferential guidelines norms. And accordingly, the market cap can be arrived at. To the market cap, we add debt, we reduce cash, we reduce any other surplus asset to arrive at the enterprise value. The enterprise value, then we map the revenue of the company in order to arrive at the sales multiple. We map the EBITDA of the company in order to arrive at the EBITDA multiple, and we can map the number of rooms or number of keys in order to arrive at the key based multiple. So in this particular case, we had mapped all the three, and for this comparable companies, the median EV by sales, EV by EBITDA was then arrived, which is highlighted in the yellow portion below. Typically, if the multiples are within a similar range for all the comparable companies we take, we can always use the average. However, in case the multiples are diverse, like in this particular case, where I have a multiple of 1.2 also, 2.8 also, and 18 and 25 also, we typically then need to use a median in order to be because the averages would kind of stretch the values as compared to a median when the range of multiples arrived is quite high. Valuation as per the CCM method. So here again the values have been computed on the basis of the target sales or target EBITDA on the basis of whatever is the past trends, and in case a 1 year forward can also be taken by in case a 1 year forward is taken, then we need to apply a present value factor to that in order to arrive at the uh, value of revenue or value of EBITDA, 1 year forward revenue, 1 year forward EBITDA to arrive at a value as of today. So once a present value factor is arrived, the same can be appropriate weights can be given based on the analysis that we have run on the company, the analysis of the competitors of how the target revenues or the target EBITDA would pan out, and accordingly the EV by sales multiple can be applied to that weighted average, and EV by EBITDA multiple for the weighted average EBITDA, and again we arrive at the enterprise value. To the enterprise value, again we make those adjustments of debt and cash and surplus investments. Now in this particular case, since there was a real estate property also, and the comparable companies that we have used are predominantly hotel companies which do not capture the value of the real estate assets. So for the real estate, we have separately added the fair value of real estate in this particular case to finally arrive at the equity value under the CCM method. So the sales multiple method gave us a value of about 41.5. The EBITDA multiple method gave us the value of about 31, and EV by room multiple, again where we used the number of rooms that are there for the hotel property, about 281 that we discussed earlier. The room multiple was applied, and accordingly the enterprise value and equity values were calculated, which gave us a value of about 28.8. Now, it is not a hard and fast rule that all of these methods have to be used on a case to case basis, depending on uh, the specific target company and the way it has progressed over the past, and the way their projections and all have been built. Either of these methods can also be taken for the purpose of third. That was the valuation of restaurant business under DCF method and CCM method. Now I am moving towards the valuation of food business. Yeah, yeah. So again, this is a company ABC, which is a Mumbai-based company. This is engaged in the business of manufacturing and selling Greek yogurt and dairy-related products under the brand name E. Recently, it had also introduced a value-added dairy-based product, the ghee, and was planning to launch other dairy value-added products. Now, typically, in this kind of food business, the the channels through which they sell their products is very important. So here in this particular business, if you see, uh, this was predominantly using all the possible channels for its sales, right from general trades, which are your local mom and pop stores, then modern trades, which are basically all those malls and retail stores like Reliance Retail and all. Then there is alternate channels, which has some based of revenues. There is the traditional distributors based model through which they are selling to their customers, and then there is direct to home, which is primarily the DTC segment. Now this company basically uh, has again the here, in order to analyze the specific sales to the specific channels, the margins that can be generated from the specific channels, the data was requested from the client on this specific format in order to have a detailed analysis of the projections, and it gives us a better sense of understanding the strategy of how the company is going to move forward and whether the achievability of the projections can be relied onto. Similarly, the channel wise costs also called from the company. uh, Again, the costs for general trade, for modern trade, for alternate channels, for distributors, and for DTC segment, the direct to home. Now, this is the margin analysis that we have done from the data gathered for the revenue and for the cost. Now, this is a typical margin structure that can be seen where you have the modern trade margin a little higher than the general trade because the products need to be pushed to the local mom and pop stores. Uh, Unlike the modern trade channel, where basically it's more of a pull based on the strategy of the retail stores and all in order to stock certain products, then the distrib the alternate channels, again, because that has to be marketed to those channels, unlike distributors, the alternate channels would have lower margins as compared to the distributor based model. The highest margins will come typically from direct to home or the DTC segment, because here we are directly selling it to the sellers, so all the intermediate costs are removed from this channel. However, it is difficult to sell directly to consumer on a consistent basis because of too many players being there in this particular in the food businesses, and it's uh, and primarily for having higher marketing expenditure and budgets in order to have a higher visibility of the brand and for customers to kind of have generate a pull for these particular products. And that's why generally the management would not rely on a single channel, even though it is the highest margin earning business, it will always look at uh, other businesses or other channels also in order to push the products. Thereafter, in from the gross margins, um, there are the typical costs that are achieved. That are there for such kind of food business. One is the delivery costs in order to get the product to the consumers. There are distribution costs for, basically these are towards whatever distributor channels that we use. There are general and administration costs, which includes management salaries and salaries, wages, and all those things. There are marketing costs, typically in order to create a brand pull and to establish the brand. There are typically marketing costs. And in this particular company, in fact, there was a brand ambassador, a celebrity brand endorsement also there, and so that cost is also getting built into the projections as well. And that's how the EBITDA is computed and the EBITDA margin gets computed. And as you can see, the company has been consistently making losses even in the past, and the growth that, so basically this was not the first year that we were valuing this. We have been consistently valuing it for last 2 3 years, and that gave us a sense of how the achievement of the projections vis-a-vis what has been estimated by the management. So we mapped that, and then on the basis of that analysis also risk premiums and all were considered in this particular case. And also given the fact that it still was an EBITDA negative company, and despite that, the EBITDA margins in the projected periods were going higher. So this is the projected balance sheet of this particular company, though it didn't have much of fixed assets. Now, fixed assets in a food product business is again dependent on the structure of the manufacturing component of the business, whether it is having its own factory to manufacture products, or it gets its product manufactured under the contract manufacturing facility. Typically, a company would use a mix of both in order to ensure uniformity in supply. Despite of that, if a company has a strong relationship with contract manufacturers, they may also opt for going for an asset light model, wherein they won't invest much into a manufacturing facilities, and they can even ramp up category of products faster in that way, without investing heavily in the assets. So that's typically how fixed assets can be analyzed. Similarly, for the working capital components, inventory planning can be analyzed on the basis of how the trends of inventory had been in the past and what has been estimated for the future. That strategy can be gotten from the management, and accordingly, on the basis of our analysis of, or the analysis of the comparable companies also, in terms of what inventories are left, we can accordingly take a judgment on the inventory values that are considered. Similarly, receivables and payables management can be understood vis-a-vis the projections, vis-a-vis what actual trends have been in the past, or what has been the trends in the comparable companies, and the overall working capital management can be considered. The borrowings again can be seen from the perspective of understanding the financial risks in the business, by way of looking at the level of borrowings to say the cash generated, or the interest coverage ratios, debt service coverages ratios. All these factors can be analyzed in order to gauge the financial risk, and accordingly the risk premiums can be assigned towards this factor also. Now, in this particular case, okay, so as we discussed in the previous slide, given that we have been consistently valuing this and we had a sense of the achievability of the projections to what has been estimated, and given that the company was still making losses, but the projections had EBITDA margins going up due to various strategies, and there were challenges in those strategies as well. So given that, uh, we had given a risk premium of 10% in this particular case, and the base cost came to about 12% or so. So 21.9% is the cost of equity that we arrived in this particular case. The cost of debt in this case was zero, since this was a startup. Lot of some bit of private equity investors and celebrity endorsers were all part of the share cap table, and they didn't have debt in the company. So that's why the cost of debt and the debt to debt by equity is zero in this particular case. And basically, which means the WACC is typically the cost of equity of 21.9%. The total inflows from various from sales to various channels were considered, and accordingly the cash EBITDA is mapped in the total inflows column. Again, the outflows is typically the capex requirement for the for maintaining the assets that were already there, the manufacturing assets. The incremental working capital was then also captured. The taxation was considered by, of course, there were losses in the company, so those losses have to be adjusted. It gets adjusted by the year 20 FY25 or so, and accordingly thereafter the MAT and the normal tax flows, and that's how the free cash flow was computed. The terminal value in this particular case is again by the Gordon growth model, and the midpoint factor is considered, as I said, because all the revenues does not get generated at the end of the year, but typically over the course of the year, and hence a midpoint factor is considered for the present value factor on a back of 22.22%. The terminal growth rate was considered at 5% in this particular case because of the uh, the kind of products that company was getting into, and also the growth rates that are still there for the retail industries, and since this company supplies its product to retail sector and consumers, 5% TVG was considered to arrive at the NPV of explicit period and the terminal period by way of Gordon growth model. The enterprise value was then adjusted for surplus cash. There were certain cash ESOPs issued, so the cash that were to be receivable on the ESOPs were also factored in. There were certain partly paid shares, even the callable amount on those partly paid shares were also considered to arrive at the equity value, which was then divided by the diluted number of shares to give effect to the uh, ESOPs also that would get converted into the shares once exercised. Accordingly, the value was computed. So that was on the valuation of hotel and the food businesses.
Thank you so much, sir, for the deliberation.
Thank you, Shruti.
Yeah, it was indeed a learning session. So we have a lot of questions which have been shared by the participants.
Yeah.
Yeah, we can take them up. So I'll ask them one by one. So the first question is
Yeah.
Horeca contribution. I'll just start. Horeca contribution being 7% GDP, but tax contribution stated to be 10% of tax collection. Does it mean food sector is taxed higher than average tax level?
So typically, that is because of the GST component and all.
Hello?
Hello. Yeah.
Yes.
Typically, that is because of the GST component and all.
Oh, okay. Okay. So are you referring to some slide or should I continue with the next question?
Yeah. So I'm saying that is because of the GST component and all.
Yes. Okay. Okay. Thank you so much.
And the
So
base is different. No, the base is not the same. So for the 7%, the base is the GDP. However, the base for this is the tax revenues.
okay. Yes. Thank you so much. So the next question is
Hmm.
when to use more than one valuation method. Some speakers suggest it is appropriate to consider one method. Is there any guidance in our valuation standards?
Yeah. So typically, ideally, it is said that we need to use one or more than one method. However, there are times when you won't be able to apply multiple methodologies. For instance, let's say a company which is currently making losses, and obvious for strategic reasons, it's still going to make losses for another 2 3 years. Now, in this particular case, I mean, it's difficult to kind of use a multiple methods. Obviously, a sales multiple methodology can be used, but however, given that profitability is not going to come in for another 3 4 years, it may be difficult to use a multiple methodology in this particular case. So typically, therein we need to take a sense on the basis of the income approach only. However, what see, and there are certain cases wherein you may not have a similar comparable companies listed, or you may not have significant amount of data for analyzing the comparable transactions to apply to our particular case. What typically happens in that particular case is you then only have an income approach method. However, what you can still do is uh, we can use the multiple methodologies even though they are not similar, by making certain adjustments and use it more as a validation for the income approach rather than as a primary methodology for the valuation.
Thank you so much for the answer. So moving on to the next question.
Hmm.
How to distinguish between the valuation drivers for valuing various categories of food items depending on the fact that these items may be semi processed, processed, perishable, and non perishable items.
Yeah, see, again, see, what happens is typically you may be able to analyze this particular data for your own target company. However, see, you have to analyze it in terms of what is there for comparable companies also, in order to get a sense of. So for example, this particular company may not be managing its products very efficiently, but if that data is available for a comparable companies, we can get a sense of that from that particular data. So that is the reason, and such detailed amount of data basically is not available for the comparable companies. Neither you will get them from your annual report, nor in the presentations. Maybe in some of the management con calls or something, if in case somebody has asked questions and they have responded to that, you may get certain data from there. However, it is very rare to get such kind of detailed data for comparable companies also to make an analysis.
Okay. So thank you so much. Moving on to the next question.
Hmm.
Since WACC contains cost of equity and cost of debt,
Right.
a highly levered company might have lower WACC due to lower cost of debt, thereby generating higher DCF values, which technically looks wrong since our debt-free business should command higher valuation. What is your view on this?
Yeah. So basically, it is not a hard and fast rule that you should take only the subject company's debt equity or cost of debt for the valuation. You can always have a check on the comparable companies, and you can always substitute a market participant view and accordingly make a valuation. So for example, if this was the case where the capital was not very efficiently managed by the promoters or the management of this particular company, and probably this has come to you for a valuation of, let's say, for a strategic uh, uh, acquisition by a buyer or something, you can always substitute a market participant level of debt and cost of debt for what has been the actual inefficient debt equity ratio or the debt cost of the company, and then accordingly make a valuation. So yes, we can use the comparable companies debt equities or cost of debts and accordingly make evaluations rather than using the subject company's debt equity or cost of debt for the valuation.
Thank you so much. Moving on to the next question. How do we assign specific percentage for company specific risk premium? Is there any methodology to calculate the same, or we assume some percentage? Please through please put on some light on this through some examples.
Yeah, so let me tell you, so there is no specific formula or a computation that can be done for this particular thing. It is largely subjective based on the valuer's judgment by the way of the analysis that he makes on the basis of the past financials of the company, the way the future projections have been built, and the analysis of the comparable companies and the trends that we have in the sector or the industry per se. Now, typically, let's say uh, uh, we can rate for the various parameters. We can rate as to what level of risk is there. So, for example, if locational risk is not there in one particular company, we can assign the lowest amount of risk and let's say a 0% risk premium for there. However, let's say there is no risk for chef and menu part also. We can, let's say, for that grid, we can rate it as a low risk and say 0%. However, let's say it is sitting with a large financial risk because of the level of debt the company has gotten into and the higher cost of debt, and on the basis of the interest coverage ratio or debt service coverage ratio, let's say we have analyzed that it's not in a comfortable position going forward also. So probably for a financial risk, you can add a 1 or 2% risk premium. Similarly, for the achievability of the cash flow, since we have seen the past trends, since we know uh, what the comparable companies are doing, uh, what is the competition intensity in the vicinity, we can also see the achievability of the growth rate or the EBITDA margins of the company. And for each of these parameters, we can specifically give any particular risk percentages and accordingly sum that up and say that for achievability of risk percentage, for example, let's say we gave 0.5% risk premium to each of this factor, and we say that 2% is the risk premium that we want to give for uh, the achievability of the cash flow segment, and then sum it all up and say that 0 plus 0 plus 1 plus 2, we have a 3% risk premium. So depending upon how aggressively the projections have been built, I mean, we can have a judgment as to what risk premiums we need to give. And secondly, here it also comes that in case you are left only with an income approach, you can always have the validation through comparable companies through which you can get a sense of uh, a range of value that a DCF should come to about based on that analysis. And then accordingly, you can calculate the risk premium that you need to assign for that value as well.
Thank you so much, sir. Moving on to the next question. Can we consider historical average growth rate of turnover upon EBITDA?
historical average growth rate of turnover upon EBITDA.
Yes.
Now I presume
Actually, it's like, can we consider historical average growth rate of turnover or EBITDA?
so for the purpose of projections,
The question does not specify that.
so I believe the question is asked for the purpose of projections. Of course,
Probably, yes.
we can always have a have that range in order to build up our queries on the projection. But see, it is not necessary that historically the way in which a company has grown, it will similarly grow in that particular direction, in that particular range only. Obviously, the company may have certain logical and uh, uh, business strategies, futuristic business strategies through which a company can grow at a faster rate also. So those strategies have to be asked to the management. There has to be discussed with them, and that has to be also considered while we take a call on whether the projections are not in line with what the company has been growing in the recent past. Uh, Also, it depends on the stage of the business that the company is in. So it will be different for a company which is started say 3 4 years ago as compared to a company which has been running for last 12 15 years.
Thank you so much. Moving on to the next question. Should we consider market debt rate or real debt rate on which borrowing was taken?
Yeah. So again, if the debt is basically taken on an arm's length basis, usually it will not be very significantly different from the market debt rate. However, let's say there is some debt infusion by the promoter itself which is not at a market rate of debt, in which case if you take the debt rate according to what interest cost is being getting debited in the company, obviously your valuation will come higher. In that particular case, you will have to always normalize that and take a market debt equity ratio and the market cost of debt.
Okay. Thank you so much. Moving on to the next question. Under CCM method, risk factors may be different and could be discounted to adjust the multiples.
Under CCM method,
Can risk factors may be different and could be discounted to adjust the multiples?
yeah, of course. So for example, all the comparable companies that you are taking may not be alike. So you can always see, again, it all depends on, you need to have that amount of data that is given by the company wide, its annual reports, its presentations and all, in order to come to a conclusion on that. Now, if you are able to get all that data, you can always analyze each of the companies, comparable companies independently, and then you can come to a conclusion on one company being more better fit than the other companies, and accordingly weight the multiples that are arrived for the individual companies, and then take a weighted average of it. That's absolutely not a problem. It is not necessary that only a median has to be taken. In case of a significant availability of data, of course, I mean, basically you need to have that much amount of time also. The client should give that much amount of time to do all that thorough analysis also. So of course, once that is done, we can always go for a weighted average by analyzing individual data and seeing how best it is a fit for our target company. So as I said, probably let's say for hotels, as I said, we can consider all the listed companies despite of the geographical segmentation, and then we can probably give a weight to the company that is more nearer to our geography of operations than someone who is not.
Thank you so much. Moving on to the next question. What are the sources for knowing the multiples of different industries?
Now, for knowing the multiples of different industries, it has to be computed. So primarily, you have databases like Bloomberg, Capital IQs, wherein which can help you gather all this data directly. Or else, the if this databases is not available, then it is a then we have to compute the market capitalization on the basis of a 3 months or a 60 days average or a 2 weeks average of as per the SAST or preferential guidelines, whichever calculation approach one wants to follow for market capitalization, and then take the balance sheet of the respective company. You pull down the debt, pull down the cash, surplus investments, arrive at the enterprise value, and then map the sales, map the EBITDA, and accordingly calculate the sales multiple or the EBITDA multiple, and map the rooms, and you can map the room based multiple also.
Thank you so much. Moving on to the next question. How does one decide which is the most appropriate method?
Again, there is no hard and fast rule. Again, it depends. So for example, let's say a company that comes to you for valuation has had no significant has had no business operation, and maybe is on the verge of distress sale or closure, then probably the cost approach would be the best method to value such companies. However, in case of going concern, you either use a discounted cash flow method or a market based multiple method. Now, using a market based multiple method would significantly depend on the stage of the business your target company is at. So, if it is at a nascent stage of business where it still has a long path to grow, again you applying a market based multiple on the recent sales or a recent profit may not give you an ideal
Result.
value. So a discounted cash flow method in that case would be a better methodology. However, in case it's a very stable business, it's growing in say that 5-10% range, you may go ahead with the market based multiples method only also.
Thank you so much. Moving on to the next question. How EBITDA multiple can be used in case of loss-making company? Can we use projected EBITDA of second year?
So you can do that, subject to, see again as a valuer, we need to take comfort on that EBITDA. So most of the times, see, management kind of gives aggressive EBITDA only. So if you are able to analyze that EBITDA and you can remove the aggressiveness from that EBITDA, and you can take the EBITDA of the second year, or else if you are convinced with the management strategies and that it will be able to achieve that EBITDA, you want to take that EBITDA, you can take that EBITDA. However, you need to make a present value adjustment to that EBITDA, because that EBITDA is 2 year forward. So you'll have to discount it by 2 years to the present, because see again, the multiple that you are using is not a forward based multiple, it's a present current multiple. So using a current multiple and applying it to a forward-based EBITDA would not be an apple-to-apple thing to do. So we need to bring that forward EBITDA to the current EBITDA by using the present value factor for 2 years, and accordingly we can use that EBITDA also, subject to the achievability is tested for that.
Thank you so much. Moving on to the next question. What are the cash equivalents? Will bank guarantee be considered as a cash equivalent?
No, bank guarantee is not a cash equivalent. So bank guarantee is something that we have given to someone for some purposes. So in case that purpose is not fulfilled, the bank will invoke that guarantee. So it's not basically a cash or cash equivalent. It's your
Thank
mark.
you so much. Moving on to the next question. How risk premium of 10% was arrived at and showed on the slide? How 21.9 was arrived as at WAC? It's referring to some slide. I am not sure which slide.
I know, I understand. Yeah. So basically, that 11.9 was again arrived by using the risk-free rate and beta and risk the CAPM there was a significant gap between what was projected and what was achieved. So it was not giving us a confidence that okay, they have tried to explain us as to what strategies they are going to use in the future, but given our past experience on the achievability, we were not comfortable as to whether they will achieve it or not. Now since that this is such a business that we will not be able to adjust the projections, and because we don't have a depth as the management into adjusting the projections, we decided to adjust the risk factor to take that into account. And obviously we had some sense of, obviously it was not a direct comparable multiple, but we took a sense from the uh, broader sector multiple that usually is there for such kind of business, and accordingly we adjusted the discounting factor so as to have the value in that range.
Thank you so much. Moving on to the next question. How is the terminal value and PV of TV calculated?
Terminal value and PV of
TV calculated.
so terminal value again is a function of what is the terminal growth rate that we use. So typically, for a very stable business, you may use a 2%, 3% growth rate also. And for a business which still has a lot of steam to grow, we can use a 5% multiple, also 5% terminal growth rate also. Once that 5% is applied, you apply it, typically theoretically to the cash flow of the last year of the explicit period. Generally it is applied. However, if your last year of the explicit period is not a very stable growth period, for example, your decided TVG is 5%, however the last explicit period is growing at 10%, you cannot directly apply it to the cash flow, because then your working capital will not get correctly calculated. You do that 5% terminal cash flow calculation on an item by item basis. You increase the sales by 5%, you consider the EBITDA margins over that sales, you come to an EBITDA number. For the incremental calculation, you increase the working capital by 5% and then take the incremental of that. You can accordingly adjust the capex also for the stable period growth factor, and then you can compute the tax on that cash flow and then arrive at the cash flow for the terminal period. So this cash flow is a 1 year cash flow, and it has to be capitalized by the Gordon growth method, which is done by you take the cash flow and divided it by the cost of the cost of equity if it is a FCFA model, or WACC if it is an FCF. So FCFF, so WACC minus the terminal growth rate. So in case the WACC in my particular case was 21.9, so I take the last year cash flow that I have computed for the terminal period, I divided it by the WACC of 21.9% minus the growth rate of 5% that I've taken, and that's how I come to the capitalized terminal value number. And when it is multiplied by the terminal value discounting factor, it gives me the present value of the terminal growth.
Yes, sir. Thank you so much. Moving on to the next question. Can you elaborate on per key multiple used for valuation?
Yeah, so typically, there are certain industries where other than sales multiple and EBITDA multiples, also you can use this thumb rule based multiples. So, for example, for a steel industry, you can use a capacity based multiples in terms of tons of capacity that is there for our subject steel plant versus what is the tons of capacity for the comparable companies. Similarly, for a hotel property, you can do it on the basis of the the value driver for a hotel property is the rooms. So basically, you can call this as a value driver multiple. So since rooms are the value driver for the hotels, what you basically do is the comparable companies also, from the annual reports, from the presentations, you can get the number of rooms of the total properties that particular listed company owns. You divide the enterprise value by the number of rooms that are there. and apply that room based multiple to the target company, and the rooms that the target company has. So in the case that I presented, for example, 281 was the target company's room. So for the comparable companies, a multiple based on the number of rooms was computed, and the median was taken. So so let's say 16 was that median, 16 crore per room was the median multiple. So I apply that 16 crore to 281, and that's the enterprise value I get for my target company. And then I make the other adjustments below the line and come to an equity value. So similar to a sales multiple or an EBITDA multiple, where the operating denominator is sales or EBITDA, in a room based multiple, the operating denominator is the number of rooms. The enterprise value remains the same.
Thank you so much, sir. Moving on to the next question. How will the valuation be affected for restaurants in case the properties are on a long term lease, say 5 to 9 years?
So in case of long term lease, so it again depends on how it is accounted. If lease accounting is basically followed, then so there are two ways in which the lease adjustments could be done. Either you remove the Ind AS impact of the lease adjustments and come to a cash rent that is incurred every year, and then don't take the lease liability below the line, because you have already adjusted that in the EBITDA calculation. So basically, cash EBITDA, from the cash EBITDA, you've reduced the Ind AS adjustment of amortization, and then you take the actual cash rent, and then don't make a lease adjustments below the line, because that is any which ways will get adjusted in the cash flows. Or else you continue with whatever is the reported EBITDA, but take lease liability below the line, similar like a debt like item. The calculations for both of these may not be exactly same, but both of this method should work.
Thank you, sir. Moving on to the next question. How significant is brand valuation in hotel industry?
uh, Brand valuation in any industry is significant. However, it is always done for a specific purpose. Typically, when you do a discounted cash flow, all the intangibles get computed. So whatever the DCF value is there, it's a value of all the tangible and intangible assets, because it's your intangible assets which are also going to generate those cash flows that are considered for projections. However, if it is a specific requirement, so let's say a hotel property is getting acquired by another company. So for that purposes, for the acquisition purposes, a purchase price accounting will have to be carried out. Now, in case a purchase price accounting is going to carried out, then only DCF value will not be sufficient. You need to compute all the values of tangible and intangible assets. So in case brand is also a part of that acquisition, you will have to separately value brand. Or in case if the or another use case could be probably, let's say the hotel company is able to mortgage his brand and raise debt against that brand, and the bank requires a valuation of the brand for that purpose, in which case also again brand can be valued. However, if you are doing a DCF and you are not required to allocate the value of the DCF to various brand, unlike in a PPA, the value of brand is already getting captured in the DCF.
Thank you so much, sir. Moving on to the next question. Will the valuation of food business be same as the valuation of beverage business?
Yeah. Sure. So see, again nitty gritties of different businesses could be different. For example, a grains business may not be the same like a beverage business or a dairy business. So nitty gritties could be different, but the concept of valuation remains the same. It's only your analysis that differs. So while you are doing a dairy business or while you are doing a beverages business, typically your comparable companies and all that you will analyze will be similar to those businesses. rather than let's say you are doing a valuation of a beverage company and you are analyzing a grain seller.
Thank you so much. Moving on to the next question. How long a typical restaurant chain can go on EBITDA negative? And how do we still work only on projections despite EBITDA losses for 7 to 10 years?
See, at some point of time, as a valuer, you need to take a call. So see, like 2 3 years, 4 years, I think is sufficient in order to have a call on whether the achievability of projection should be questioned. In which case, you can either adjust the projections yourself on the basis of, let's say, the trend of failure of projections you have seen across over the number of years. So for example, you have always seen that on an average the management misses its projections by 50%. You can take a call on that adjustments if you want to do that adjustments that way, or you can convert. If you don't want to make a change in the projections, you can convert that calculation into what amount of risk factor you need to assign in order to have a value in that range, rather than continuing with the same projections and same WAC and without making any further adjustments once you have a sense of that it is not getting achieved. I mean, obviously, if it is a very technology platform company, that could be a case. But see, now for technology platform also, previously there were issues, but now even Zomato is listed. So even technology platform can have a validation that can be done using Zomato and then making appropriate adjustments to multiple, and we can always have a call on what we can do.
Thank you so much. Moving on to the next question. For terminal value computation, you mentioned a model. Can you provide a brief overview of the concept?
So, see, the Gordon-based model typically says that post the explicit period, your company will grow at a stable rate. Okay. Now, let's say as a valuer, you said that looking at the stage of the company, the amount of growth that is there for the business, you say 5% is the stable rate growth that the company can achieve over the perpetuity period. So your cash flows after the explicit period, which means will grow by 5% more. So that is, your previous year cash flows will grow by 5% more, and that cash flow is for a single year. Now, terminal period is basically a group of, say, next 12, 15, 17 years. So terminal value cannot be a single year value. So in order to capitalize that, to arrive at a cumulative value for the number of years that are there in the perpetuity period, we typically have the Gordon growth model, wherein you divide the cash flow for the terminal period with the TVG that has been considered, say, 5%. That cash flow will have to be divided by cost of equity, or WAC if it is an FCFF model, WAC minus the growth rate. So you have a cash flow, you have a WAC, you have a growth. So your WAC minus the growth rate is basically the capitalization factor, so to think. So your cash flow is getting divided by that capitalization factor, and that is basically becoming your cumulative value of the number of years that are left in the perpetuity period, and that gets added to the explicit value. So explicit value, if you are doing it for a 5-year period, the perpetuity period could be another 12, 15 years. The Gordon growth based model will capitalize the single year terminal value for the remaining 12, 15 years ka perpetuity period, and the cumulative value will be the enterprise value.
Thank you so much. Moving on to the next question. We have noticed in a steady state existing business, capex calculation are excluded from DCF method. Is there any specific reason that you included in the startup valuation example that you've shared?
See, again, in a stable growth rate business, also it is not necessary that capex calculations may not be there. Ideally, some amount of maintenance capex could be there for a company depending on the nature of plant and machinery and building and those other assets that are owned by the company. So you may not have an exactly zero working capital, but capex, but it could be a maintenance capital expenditure that would be there. Obviously, for a stable growth company, if they do not have any plans to expand, you may not have a growth capex. For a startup company, in my particular case, there were some amount of new product launches and all that were going to happen. There were some amount of different kind of plant and machinery required for those kind of product expansions. So that is the reason why there was a little amount of growth capex also there in my projections. And beyond that, it is all maintenance capex that is there.
Thank you so much. Moving on to the next question. How do we quantify certain metrics like location, menu, etc., while valuing the restaurant?
These are very subjective. It is not that there is a scientific formula to arrive at that. It is very subjective. So again, on the basis of see again, as I said, you can always go through the user ratings and reviews and get a sense of how see ultimately as a valuer we may not be able to judge the quality of the menu, but users who are actually consumers of it may be able to judge it. So if you have very bad reviews on that, you have a 2-star rating on a 5-star for that particular menu for that particular property, which you can probably look on Google reviews and Travelophilia and Expedia and those kind of websites, and then take a judgment on that.
Thank you so much. Moving on to the next question. How the valuation is done in respect of supplies made to chain like Swiggy as compared to restaurant sale or takeaway in computing gross merchandise value?
So for a restaurant, typically what happens with Swiggy, these platforms like Swiggy and Zomato, see they have their own cuts on their own commissions. So whatever sales are routed from their platforms, they cut whatever their platform fees is, whatever their commissions is, and accordingly, what the hotel or the restaurant gets is a net value. So basically, that net value typically will have to be considered in case the sales are made through this platform. Okay, if you are making a direct sale to a consumer, you can always take the full value of the sales as a GMV. But in case if you are routing it through someone, ideally, I mean, obviously, the promoters and management will obviously not want that, and they would want to take the full value as the GMV. However, but if it is routed through the platforms who have their own commissions and cuts and uh, uh, platform fees and all, we should ideally take what is going to come to the company as a GMV. Because that full value is any which way is not going to hit the bank account of the restaurant. Restaurant is only going to get net from Swiggy and Zomato. But again, it's how the management use and what adjustments as a valuer we need to make.
Thank you so much. Moving on to the next question. Do we need to rely more on subjectivity based on one's assessment than the objectivity, as no single standard formula can be adopted irrespective of valuation method chosen?
Yeah. So typically, see in many of the things, no, there is no set formula that is there. So it is in that case it goes by the experience of the valuer, number of valuations in that sector a valuer would have done, the sense he would have had on that particular industry. So on the basis of the refinement of that judgment, obviously there is some uh, uh, what you call some things that can be factored into analyzing what amount of risk premium to be given to that particular case. So in terms of objectivity, that can only be done if there was any set formula that was there. But unfortunately we don't have any such kind of a formula in which we can do a complex calculation of how to arrive at the risk factor. It will have to be on a subjective basis, and that's why valuation is an art. No?
Uh, Thank you so much. Moving on to the next question. Please shed some light on the per key valuation technique. Is the EV allocated to all types of rooms equally? Or is there a weighted method to allocate EV to AC or non AC rooms? In other words, room having higher rent should have more per key value. Is that right?
Yeah, that's correct. That's correct. See, however, the problem here is, your enterprise value, you cannot divide it because enterprise value again comes from market capitalization, wherein you will not get any sense of what market cap, what price market is giving to room rents and non AC room rents and non AC room rents. But obviously, what you can do is you can give weights to the rooms. So, for example, in my case, 281 were all AC rooms, okay, being a five-star property. However, in case you have AC and non-AC rooms, let's say totaling to 281, you can probably give some higher weights to the AC rooms and the lower weights to the non-AC rooms in order to adjust for that room rate difference between these two, and then accordingly consider for your case. However, it also depends on whether that similar details is available to you for the comparable companies also. Now, for all cases, you may not be able to find that difference for the comparable companies, because then only you will be doing an apple to apple calculation for comparable companies and applying that to our company.
Thank you so much.
Possible to do that.
Sorry.
Yeah.
Moving on to the next question. Risk of erosion of current level of business due to acute competition. How will it be factored in valuation?
So again, as I said, competitive intensity, location and competitive intensity is one thing that you can always factor in while calculating the risk premium. Now, obviously, while you are looking at the target company, you can also gather data with respect to the competitive intensity that is there in that particular region. You can always map other hotel properties who are probably under constructions or already operating in that particular space, and then have that specific question pointed out to the management to get their view also, and in as to how they are also looking at that competitive situation and what strategies they also have in place for mitigating that. However, if that is something that as a valuer we are not convinced in terms of the ability of the competitors also to kind of say uh, use other approaches in order to cut down on our target company, and then we have a judgment as to probably will not be able to achieve that margin or that sales with this competitive intensity. That factor can always be considered in the risk premium, and accordingly we can probably have a higher assign of the risk premium for that factor.
Thank you so much. Moving on to the next question. How much difference we can take in fair value and liquidation value in case of liquidation of company?
Again, it all depends. I mean, there's no set formula as to what amounts difference could be there for a fair value and for a liquidation value. Typically, what I have seen is about 40% discount typically running. But again, it's not a very scientific calculation by which that number is arrived. It's more of a judgmental values that typically value are assigned.
Moving on to the next question.
And those are not in the hoteling industries, of course. I mean, those are in the other sectors that I've seen.
Okay. Moving on to the next question. In case of a branded hotel in existence for a long period, say 50 years, the cash flow already has impact of brand premium. Do we still need to value the brand separately?
No. See, again, as I said, if you are doing a discounted cash flow valuation, the brand value already is embedded in the DCF value that is arrived at, because the cash, see, ultimately what the value of the brand ultimately flows into the cash flow, into the sales that I make, the margins that I make. So if I have already considered that, my value of brand is already encapsulated in the DCF value that I'm arriving, unless it is for some reasons you have to allocate a DCF value to various assets, like in case of a PPA, purchase price allocation, you then have to separately carve out the value of the brand from within the DCF value. So if my DCF value is coming, let's say, to 1,000 crores, I cannot have a brand value of 100 crores separately computed and added to the DCF value, because my DCF is already containing the brand value. So in case I have to do a allocation from that 1,000 crores, I will calculate and say that 100 crores is the brand value. So I remove 100 crores. I have another 900 crores that will go to other assets, tangible and other intangible assets, like say customer relationships, or whatever is not allocable to any asset will remain as a goodwill.
Thank you so much, sir. There are a lot many questions that the participants have asked, but due to paucity of time, we will have to end the session here. It was a great, insightful session, and it was a great learning experience. Thank you so much for sharing your wisdom with us. It actually helped us to get a new perspective and continue with this enriching journey in valuation expertise. So, dear participants, as we conclude this session, we extend our sincere thanks to a distinguished speaker, CA Sujay Paiji, for his valuable insights. We also express our gratitude to our chairman, CA Hansraj Chuk, Sir, Vice Chairperson, CA Preeti Paras Savla ma'am, and the entire support team of ICAI for initiating and supporting this platform for the field of valuation guiding us. Last but not the least, we would like to acknowledge and appreciate our audience for dedicating your valuable time and for your active participation, even on a Sunday. Thank you so much. Please fill in the feedback form, which is available to you. Your feedback helps us improve. And we are eager to meet you again in our upcoming sessions. Thank you so much. Have a wonderful day ahead.
Thank you.